Today, I want to talk about position size and its importance with an example of a simple strategy which uses moving average crossovers. What we see here is the Bitcoin chart in the USD pair. Now, if we simply analyze this, I think we did a very simple analysis in the previous video where we had discussed long position, short position, stop loss band, and moving averages. And in this video, I want to give a proper example of how we can compute our position size and make a paper trade. Paper trade is simply fake money, and you are trading on your Excel sheet or Google sheet and taking a long position with fake money and computing how far is the stop loss, or basically taking the stop loss into consideration of your position size and taking the reward at a particular risk to reward ratio. Now, before we go further into the topic, I would like to welcome you to the CryptoPi channel, the hub for transforming trading using technical analysis and risk management. If trading using technical analysis is something which interests you, then engage with the channel by subscribing, liking, commenting, and sharing. Let's get back to our strategy. Alright, so this is the basic chart or the very raw chart. And these are the two topics which I mentioned in my intro, that you can have various strategies and you can define how to take your long and short entries. And sometimes people make lots of money during bull market when they are going in a long position, but rarely those same traders or investors make money when it's a bear market, because they do not take a short position, or rather they are not investors or traders. They are in some sense risk takers without any risk management. Now, a workaround in this situation is to understand what a position size is. Position size is basically a percentage of the risk which a trader takes from the total amount of trading amount which they have dedicated. Actually, it's less than the trading amount if you consider the leverage. But maybe that is the topic for some other video. For today's video, let us assume that the trade is taken based on a percentage, taking a percentage of the risk of the total trading amount. But before that, coming to the first topic of trading strategy. What I have here are a few custom indicators and few default indicators which are provided by the community. The first one, which you might be aware of, which I discussed in the last video. If you haven't seen it, do have a look at it. The link is in the description. What you see here is the stop loss band, where whenever one sees the red band, it's basically the downtrend, and whenever there is a green band, it is considered as the uptrend. Although this looks like a trend indicator, I mainly use it for computing stop loss. To give a short recap, let's say my strategy, doesn't matter which one, everyone can have their own strategy, tells me that at this particular point I should be taking a short position. So I'll use the short position tool. I would click here at the close of the day, and I will adjust my stop loss above the red band here. Now, based on how far my entry position is with respect to stop loss, in this case it is 8.68%, I will compute my position size. And if the market goes against my idea or against my calculation that it has to go downwards, then my stop loss will be hit and I will lose a small percentage of the trading portfolio. In this case, if I have decided to take stop loss at 8.68%, and if I decide to take my reward at risk to reward ratio of 2, then it does not hit my stop loss. Now, at the same time, if the trading strategy tells me to take a long position over here, although let's take the one where we can see an uptrend going. Yes, this one is a good example. Let's say the trading strategy tells us to take a long position at this candle close. So we would enter here and I would set my stop loss below this green band. Below this green band means my stop loss is at 17.18% away from my entry point. Now, if I'm taking a position here, I would have no clue if it is going to, if the price will go in the direction which I have calculated or in the direction other than that. There is no other option. Either it goes up or either it goes down. Now, when it goes down, the range of stop loss helps the price action to play around, let's say it like that, to grab the liquidity, to create a new price action within this range. And if our calculations are right, the price does not hit stop loss. But if calculations are wrong, then price does hit stop loss over here. What happens at stop loss is one loses the percentage risk which was taken. Alright, so that was a short recap of what a long position does, what a short position does. Now, coming to the trading strategy with moving averages. For the moment, let's hide the stop bands again, and I'll switch on the trend bands, where I have grouped a couple of moving averages as SMAs, simple moving averages, EMAs, exponential moving averages, quick MAs, which indicate an uptrend and the downtrend and are represented just by one moving average, and the crossovers of moving averages. There are a few other, let's say, indications using support and resistance bands. They are also based on moving averages. However, for this video, perhaps they can be left out. Let's see. Okay, so first I want to show is, let's select all the three. If I would select group MA, what would happen here is we see all the three moving averages, which are simple moving averages, at length of 50, 100 and 200. For this particular strategy, let us just take MA1 and MA3. And from group 2, if I would select group 2, we would see three moving averages with the length of 12, 24 and 48, three exponential moving averages, and you can see it quite clearly. Let's hide this one, that they are much closer to the price action compared to simple moving averages. EMAs tend to move with the same or very close to the price action. SMAs, whereas on the other hand, move far away from the price action because the computation is quite different. One can easily look up with a simple search the difference between a moving average, a simple moving average, and an exponential moving average. Now going to the third group, which is QMAs, quick MAs. Let me activate QMA1, QMA2. What you would see here is whenever the trend is upwards, they are highlighted as green. Whenever the trend is downwards, they are highlighted as red. For the strategy's sake, I will be selecting only QMA3, which is with the length of 42. No particular favoritism here. We can use 13, 21, 40, 42, or one can use 15, 20, 45. It depends upon the asset, it depends upon the trading style, and it depends upon what the community usually follows, or a general rule or a set of unwritten rules which a community follows. And there is one more thing, which are the MA crosses, and that is, if I would switch on MA crosses, we will see here that it is S13 or L13. That basically means it's the crossover between the moving average which is selected in the first option and the third option. Here the first option is MA4, and that would be this one, that is a 12 moving average, exponential moving average, and MA6, that is 48 exponential moving average. So let's switch on group 2 to visualize it better. Whenever the 12 exponential moving average, that is the fast moving average, crosses over 48 exponential moving average, it will indicate L13. So that is a long position for the first chosen moving average and the third chosen moving average. Whenever it crosses under, then it is a short position, that is over here. So blue one crosses under, and that is over here. Okay, this would be the first strategy. Let's consider this one without any quick MAs or anything else. I am right now on a day frame, a daily time frame, and alright, this volume bars can be hidden for the moment. We are not using that as indication for the trading lesson here. Let's take the typical example which we have discussed in few other videos. On September 20th, 2024, we see the fast moving average crossing above the slow moving average, which is an indication of a long position. So I take a position here, I scroll in, I would select here, and I define my long position. Now the next step is to define the stop loss. However, here the band is in the downtrend, but it doesn't matter. Let's take stop loss up until this swing low. I discussed two of the strategies for stop loss. One was the stop loss span, and the other was the swing points. So instead of this swing point, let's consider this swing point, but this swing point will exist only if there are 14 candles which has passed. We can identify if the 14 candles are passed by the option which we can see it in this one or this one. Okay. Here, date range. So we have to go backwards 14 bars, 14, 12, 14. Seems like it would have shown at this point. So that's this swing low as a stop loss is fine. Let's select this one and move our stop loss slightly below the swing point here. The stop loss defined here is at 17.19, and we wish to consider our risk to reward at 1.5. However, at this point we have no clue where the reward will end, or whether the reward will be reached or the stop loss will be hit. We are simply taking a position at this point. What we can define is our stop loss, nothing else. And we can assume that reward will reach at 1.5. Now, how do we calculate it? We had discussed a very simple position size formula. Let's say one has the trading amount of $1,000 and one wishes to take 1% risk. So the risk taken will be 1% of the trading amount, that is $10. Now here this was an example which was at stop loss of 2%, but in our case the stop loss is at 17.19%. So we go back here, make 17.19, and you will see that position size will change for 17.19 to $58. So one has to take the trade with only $58. Of course, there are fees which are to be added here, but for the understanding of the position size, let us keep fees and exchange rates out of the picture. So I will take the entry of $58 and no more. With this $50, I preserve basically all of my capital. If at this point the price goes in a different direction, so it hits my stop loss, what I would lose is simply $10, no more than $10, because that is the risk which I'm taking here. However, as we see in this particular example, that the trade would have been successful, so we could exit at the risk to reward of 1.5 approximately, so that is 25.78%, and here my reward percentage is 25.78, so that comes to the risk to reward ratio of 1.5 if you round it up, and that will give me the price or my profit. Let's calculate profit. My profit will be my position size plus my position size multiplied by my reward percentage. Oops, that's not correct. Something messed up. Oh, that's a percentage, so it has to be divided by 100. So this will be my profit. So on taking on taking just $58 and taking reward at 25%, I already gained $15. Now in this case we are on the day time frame, so it obviously does not make a lot of sense to trade with $1,000 and wait almost let's calculate that. How many days would one have to wait to make that $15? That's 51 days. That's a lot. But like I said, it's the day time frame. But what if we are not on the day time frame? Let's get rid of all our drawings. What if it's not day time frame? What if it is a 5-minute time frame or a 3-minute time frame? And you can see that this is live paper trading, so no new or no old calculated price actions to be shown. But now I want to check for what will be the position size for this particular trade. If I would have taken this as my, actually I could not take this as the swing low as the stop loss because 14 candles has not been passed. So my long position over here would take the stop loss just below this. That's 0.42. This is something very tricky which I have found out. If your stop loss is below 1%, it's best to use, in this case, leverage. And I think this brings out a completely different discussion. Let's move to perhaps on higher time frame where our stop losses are above 1%, and I would bring this topic up in one of the future videos on how to work with leverage when the stop loss is below 1%. Let's see if we find something on a 15-minute time frame. All right, so here we have again L13. Let's see if our stop band also has green line. So perhaps in this trade I can use the stop bands if I want to take a long trade on this line. All right, and I would scroll in and my stop loss would be just below the green line here. So my stop loss here is 1.71%. Let's go back to the risk management sheet. My risk always remains the same. So this risk always remains the same. Why do I say remains the same? Is because this will help to basically have the or basically compare all the trade with a same risk level. Of course, one can change from 1% to 2% to 50%, depends upon your risk appetite, but it's good to keep it at the same level so one can trade with the same risk level and then track the progress on how it is going and how the portfolio is going, whether it's in profit or in loss and what can be changed. All right, so we keep the risk at 1%. Our stop loss is at 1.71. So risk taken is $10. Stop loss is at, oh, it's the same, 1.71, just one more decimal shift. The position size now is 584. And where do we assume our reward will be? Let's continue to make it to 1.15, and it would take us basically from June 6th, and it's still approximately 11 hours or slightly less than 11 hours, so 10 hours 15 minutes. If the stop loss, the stop loss does not touch, so maybe not. Perhaps it would take few longer, much longer time to reach 1.5. So that is on the next day. And for the profit of 2.61, so here reward is 2.61. The risk to reward becomes 1.5 and the profit is $15. If I take a trade on this point, if I have defined my stop loss, if I defined my take profit, I can leave my trading laptop away, spend time with family, spend time with friends, do some other work, read a book, and now you are free of worrying whether the portfolio will be completely gone or not. One will stop looking at their account every other minute. I know what is my position size. I know if the trade goes against my calculations, I know exactly how much I will lose. And I know if my calculations are right, if the trade goes in the direction of my calculations, I will also know exactly how much will be my profit. So this was a very simple strategy. Of course, there are numerous other ways to find a long trade, to find a short trade, and maybe take more than one trade over here, or maybe take one large trade for a duration of 1 hour, and this would probably take days to work out. Let's take this one, but I want to also show not with the crossover, or we still keep the crossover, but we will use the quick MA, and we can hide group 2. So there are now two conditions. The first condition will be that there should be a crossover, and along with it, for the quick MA should also be in the same direction, should also indicate the same direction. So here there is a crossover indicating a short position, as well as the quick MA is indicating a downtrend. So for this short position, at the end of this hour, because it's the close of the hour, my stop loss band also here shows a red one. So I will extend it just above the red line, the red dotted line. My stop loss is at 2.76, and I would compute my risk to reward at 1.5 over here, approximately 1.5. Let's do the calculation again. Trading amount is 1,000, risk is 1%, my stop loss is at 2.76. My position size is $362, and my reward is at 4.18%. My reward percentage is 4.18%. And it would take the trade approximately from 27th May till 30th May, 3 days to execute a profitable trade of $15. Great. So to summarize, One is that doesn't matter what your trading strategy is. It can be simple moving averages, it can be momentum trading, it can be some other oscillator divergence, or it can be purely price action based on order blocks, or it can be level to level trading. What is important is how one computes position size, or rather one can say how one manages their risk. How do they define their risk? Is it 1% of the risk, or is it 50% of the risk, or one takes 100% of the risk? And once the trader understands how to compute a position size, how to compute the risk for each of their position which are actively being traded, they can preserve the portfolio from being liquidated. And once you have the capital to trade, there is a good chance to make more profit rather than having lost all the capital by taking a heavy leverage of 100x. But that is, again, like I mentioned, it's a topic for some other video. But for this one, I think that would be all. And thanks a lot for listening, for having a look. I would appreciate a feedback if you liked the video. There is also a link for BuyMeACoffee to support the channel. And do like and subscribe if you feel like, and engage with the channel so that I can bring out more videos as such. Thank you very much. See you in the next one. Bye-bye.